What's up guys, Victor here. So this week we received jobs report which came out relatively strong. The main implication of this is that there is now a lower risk of a recession. I want to explain this on a metaphor. Imagine a plane being the metaphor for the economy, the Fed being the pilot, the pitch being the inflation, and the speed being the employment. If you have too high pitch, you run the risk of stalling and falling down. If you have too low speed, you run the risk of halting, falling down. So really the data from this week tells us that the plane, the economy, is still flying at a good speed, which gives the Fed more headroom to control the pitch. The Fed controls the pitch by interest rates. Imagine the elevators at the back of the plane. So now they can work with the pitch, with the interest rates more aggressively without running the risk of incurring too much of a drag on the plane, without running the risk that the plane will fall down. All in all, good news for the economy, mixed bag for the financial markets, as yes, on one hand, there's lower risk of recession now, but higher interest rates are not good for financial markets. Turning to weekly performance, Nasdaq this week up by 6%, S&P up by 3%, volatility down by 14%, growth outperformed value, and yields up across the board, but we are still seeing an inverted yield curve. Heat map, technology, communication services, consumer cyclicals up, energy, utilities, basic materials down. Digging deeper into the key data, so in June the economy added 372,000 jobs. So we are now shy 500,000 jobs from pre-pandemic levels. From a sectoral point of view, all sectors except the leisure and hospitality are now at or above pre-pandemic levels. Looking at the ratio between job openings and job seekers, there are now 2 job openings per 1 job seeker, which is pretty high. But we are seeing indications that this should go down. If you look at the job openings curve, it is starting to trend down, and the job seekers curve is flattening out, and we might see this coming up. Why? Well, the labor force participation rate is relatively low at 62%. A lot of people, especially in the age category 55 plus, are choosing not to work. But with the inflation and increased cost of living, some people might be compelled to return to the labor force. This week I also want to quickly touch base on the Federal Open Market Committee minutes. What the Fed said and what I found interesting is that there's a significant risk that elevated inflation could become entrenched if the public began to question the resolve of the committee. Translating to plain English, the Fed is afraid that the elevation could stay if the public thinks that the Fed will not act strongly. So my interpretation of this is that the Fed going forward will really have strong language, trying to show their resolve to end inflation. They will be hiking strongly as well. Some interesting news from this week. Elon Musk announced that he is terminating acquisition of Twitter. This will be interesting to observe, as this will most definitely end up in court. And as Julian here says, material adverse effect has only been successfully proven once. In the crypto land, another crypto company files for bankruptcy, this time Voyager Digital. But we are starting to see some positive news. SBF, the CEO of FTX, said that FTX has more than $2 billion to backstop crypto industry. So last week they backstop BlockFi, and now they will be sweeping the floor at highly discounted prices. And I believe Binance announced a similar message this week. In this week's episode, I also want to quickly touch base on the situation in Europe. I myself am originally European, so this really hits close to home. So there is a gas shortage in Europe. It is starting to impact everyday life, such as in Germany. They are starting to ration hot water, starting to dim street lights, shutting down swimming pools. And guys, keep in mind, it is middle of summer now. It is impacting electricity prices. We are now at 350 euros per megawatt hour. A couple of years back, I worked on some energy projects and we never expected energy prices to go up above 50. And a small anecdote from Europe. Well, a gas turbine for Nord Stream 1, which is a gas pipeline from Russia to Germany, got stuck in Canada due to sanctions. And the European officials are now discussing how to circumvent these sanctions and get the gas turbine back to Russia so that Russia could continue supplying gas to Europe. A ridiculous situation. Gas shortage is starting to impact economy, so the German balance of trade dipped to levels not seen since 1990s. It is starting to impact politics. The spread between the German and Italian bonds has been increasing. This, of course, increases the risk of European Union fragmenting, and it makes the life of the European Central Bank harder. The European Central Bank has an implicit dual mandate. On one hand, they need to control inflation and employment. On the other hand, implicitly, they defend the unity of European Union. And lastly, we got the news today or this week that Finland and Sweden completed talks to join NATO. This has security implications, increasing the risk of a military action. So if you take all of this together, the energy situation, the economic situation, the political situation, the security situation of Europe, Europe is in a bleak position. And we can see that being manifested in its currency. The euro dropped below a long-term support line against the USD. It is on its course to parity with the dollar, and I wouldn't be surprised if it dipped below. I am seeing in my day job people starting to diversify away from Europe towards the US, the Asia, Latam. Not a good view for Europe. To conclude, next week we will be getting some key data: CPI on Wednesday, PPI on Thursday, unemployment claims on Thursday, retail sales and consumer sentiment on Friday. Next to that, the earnings season will start to ramp up. That's all for this week. Thanks guys. See you next week.